Welcome to the DX Today podcast, your daily deep dive into the AI ecosystem. I'm Chris, and joining me as always is Laura.
Hey, Chris, and wow, do we have a jaw-dropping story to unpack today? Because the Q1 2026 venture capital numbers just dropped, and they are absolutely staggering in every possible way.
Okay, so I saw some of the headlines flying around about record-breaking funding numbers. But give me the big picture here, because I want to understand the full scale of what just happened this quarter.
So according to Crunchbase data that just came out, investors poured $300 billion into about 6,000 startups globally during the first quarter of 2026 alone, which is an all-time record that no other quarter has even come close to matching.
$300 billion in a single quarter is genuinely hard to wrap your head around. So help me put that number in context compared to what we saw in recent years and previous quarters.
Here's the context that really makes it sink in. That single quarter of funding equals roughly 70% of all the venture capital that was invested throughout the entire year of 2025, and it represents a 150% increase both quarter over quarter and year over year.
So we basically compressed almost an entire year's worth of venture investment into 90 days, which raises the obvious question of where all that money is actually flowing to and what sectors are attracting it.
And this is where it gets really telling about the state of the tech industry right now. Artificial intelligence captured $242 billion of that total, which works out to roughly 80% of all global venture funding in the quarter.
80% going to AI is a concentration level that I don't think we've ever seen for any single technology category. So is that healthy, or does that start to look like a dangerous level of concentration to you?
That is the trillion-dollar question, literally and figuratively, and I think the answer depends entirely on whether you believe this is a durable platform shift like the internet was, or whether this is more like the dot-com bubble where capital allocation became irrational.
Let's dig into who specifically is pulling in these enormous rounds, because I know there were some mega deals that were historically unprecedented in terms of their sheer size and scale.
The four biggest deals of the quarter tell the whole story. OpenAI raised $122 billion, which is the largest venture deal ever recorded in the history of startup financing. Anthropic closed a $30 billion Series G, xAI pulled in $20 billion in a Series E, and Waymo raised $16 billion.
So those four companies alone raised $188 billion between them. And if my math is right, that means just four companies accounted for roughly 65% of all global venture investment in the quarter.
Your math is exactly right, and that level of concentration in just four companies is genuinely unprecedented in venture capital history, even during the height of the dot-com era or the mobile revolution that followed.
Let's talk about OpenAI's $122 billion round, specifically because that number almost defies belief. Who is writing checks that large, and what does it imply about their expected trajectory?
The round was backed by some of the biggest names in finance, including Andreessen Horowitz, D.E. Shaw, MGX, TPG, and T. Rowe Price. And it actually included an additional $10 billion tranche announced in March on top of the initial $110 billion from February.
And Anthropic at $30 billion with a $380 billion post-money valuation is also remarkable when you consider they have raised nearly $64 billion total since 2021, which is an astonishing trajectory for a company that young.
What really stands out about Anthropic's trajectory is how quickly the valuation has climbed. They went from being a small safety-focused research lab to being valued at $380 billion in basically 4 years, which tells you something about how the market values frontier AI capabilities right now.
Now, beyond the big four frontier labs, I'm curious about what's happening further down the funding stack, because that tells us more about whether this is a broad ecosystem build-out or just a top-heavy bubble.
There is actually really encouraging data at the earlier stages, too. Early-stage funding totaled $41.3 billion across 1,800 deals, which is up 41% year over year, and seed funding hit $12 billion, which is up 31%, so the growth is not just at the top.
That early-stage growth is interesting, but I noticed something counterintuitive in the seed data. You said seed funding dollar amounts went up 31%, but what happened with the actual number of seed deals that were getting done?
Great catch, because seed deal counts actually fell 30% to 3,800 deals, even though the total capital went up, which means the average seed round is getting significantly larger and investors are concentrating bigger bets on fewer companies at the earliest stages.
So even at the seed stage, we're seeing this concentration dynamic where fewer companies are getting funded, but those that do are getting much larger checks, which feels like it could be squeezing out a lot of potentially interesting startups.
Exactly, and that trend extends to some truly wild seed rounds. Advanced Machine Intelligence, which was founded by Meta's chief AI scientist Jan LeCun, raised Europe's largest seed round ever at $1.03 billion for world model development, and World Labs pulled in $1 billion for three-dimensional world foundation models.
$1 billion seed round is something that would have been considered absolutely absurd even 2 years ago. So the definition of what constitutes early-stage funding has clearly been completely redefined by the AI boom.
It really has, and I think that redefinition reflects a genuine belief among sophisticated investors that the winners in foundational AI will be determined in the next 12 to 18 months, so there is an urgency to deploy capital at scale even at the earliest stages.
Let's zoom out geographically because I'm curious whether this AI investment boom is a truly global phenomenon or whether it is concentrated in specific regions that have particular advantages.
The geographic concentration is actually more extreme than the sector concentration. US-based companies raised $250 billion, which is 83% of all global venture capital in Q1, up significantly from 71% in Q1 2025.
So the United States is pulling further ahead in terms of capturing global AI investment, which must be creating some serious anxiety in other tech hubs around the world about falling behind in this critical technology race.
China came in second at $16.1 billion, and the UK was third at $7.4 billion. But the gap between the US and everyone else is widening dramatically, which has major implications for geopolitics and the global distribution of AI capabilities.
Now let's talk about the elephant in the room, which is whether this level of funding is sustainable. Because $300 billion in a quarter implies an annual run rate of over $1 trillion, which seems extremely aggressive even for AI.
Venture analysts are actually split on this question in a really interesting way. Some see it as a necessary and rational response to a genuine technological revolution that requires massive capital deployment, while others are warning that the inflows increase what they call systemic fragility.
What do they mean by systemic fragility in this context? Because that sounds like it could have some really serious implications if things don't go according to plan for these heavily funded companies.
The concern is that many of these companies are carrying enormous fixed costs for specialized hardware, GPU clusters, and data centers. So an abrupt funding slowdown or a regulatory shock could disproportionately hit companies that have built their business models around sustained access to cheap capital.
That reminds me of what happened with some of the cloud companies in 2022 when the funding environment shifted. Companies that had been burning cash aggressively suddenly had to find a path to profitability very quickly.
Right, and the scale of potential exposure here is orders of magnitude larger than what we saw in 2022, because these frontier AI labs are spending billions per quarter on compute alone, which makes their burn rates unlike anything we have seen in venture-backed companies before.
Speaking of spending on infrastructure, I know the data showed that a lot of this capital is flowing not just into software, but into physical infrastructure too, which represents a different kind of investment thesis than traditional venture capital.
That is one of the most underappreciated aspects of this funding cycle. Massive capital is flowing into the physical foundations that support AI growth, including nuclear-backed energy systems, grid-scale storage, next-generation semiconductors, and even orbital data centers, which makes this fundamentally different from previous tech booms.
Orbital data centers, as in actual computing infrastructure in space. That is a level of ambition that really underscores how seriously investors are taking the long-term compute demand projections for AI.
It sounds like science fiction, but multiple companies are actively pursuing it because terrestrial data center capacity is genuinely becoming a bottleneck. And the energy requirements for training next-generation models are pushing the limits of what ground-based power grids can deliver.
Let's shift to the exit side of the equation because all of this capital flowing in eventually needs to find a way out. What does the IPO and acquisition landscape look like for these heavily funded AI companies?
The exit picture is actually quite complicated right now. U.S. IPO activity slowed this quarter amid a broader software sector sell-off, while China's IPO market actually picked up strength with several AI companies listing on the Hong Kong Stock Exchange at multi-billion-dollar valuations.
It's interesting that no foundational AI model company has gone public yet, despite these enormous private valuations. So when do people expect OpenAI or Anthropic to actually IPO and face the scrutiny of public markets?
The consensus seems to be late 2026 or 2027 for either OpenAI or Anthropic to go public. with Toronto-based Cohere also being mentioned as a possibility after their $500 million raise at a $6.8 billion valuation last August.
On the M&A side, I know OpenAI has been extremely acquisitive. What does their buying spree tell us about the strategic dynamics in the AI ecosystem right now and where these companies see gaps in their capabilities?
OpenAI completed 6 acquisitions in early 2026 alone, almost matching their total of 8 deals for all of 2025. And the targets are really interesting. They bought Astral for open source developer tools and PromptFoo for AI testing, which tells you they are building out a complete developer platform ecosystem.
That platform strategy makes sense because if you are going to sustain a valuation built on a $122 billion funding round, you need to build multiple revenue streams and deep ecosystem lock-in beyond just model access.
Absolutely, and I think we are going to see more of this consolidation as the larger AI companies use their war chest to acquire capabilities they need to build defensible moats, which will further accelerate the concentration of the industry.
The unicorn board adding $900 billion in value in a single quarter is another statistic that really jumped out at me. That is an extraordinary amount of paper wealth being created in the private markets.
$900 billion in a single quarter means the unicorn board's total value is approaching levels that rival the GDP of medium-sized countries. And the question everyone should be asking is whether those paper valuations will ever be validated by public market investors when these companies eventually go public.
So pulling all of this together, what is your overall read on what this Q1 data tells us about the state of the AI ecosystem and where we are headed for the rest of 2026?
My read is that we are witnessing a genuine historic reallocation of global capital toward artificial intelligence at a scale and speed that has no precedent. And whether that turns out to be visionary or reckless will largely depend on whether the technology delivers on the revenue and productivity promises that justify these valuations.
And I think the key metric to watch going forward is not just how much more money flows in, but whether these massively funded companies can start converting their technological advantages into sustainable business models that generate real cash flow.
Exactly, because at some point the math has to work. You cannot sustain billions per quarter in compute spending indefinitely without demonstrating a clear path to profitability, and 2026 is shaping up to be the year where that question gets answered definitively.
That's all for today's episode of the DX Today podcast. Thanks for listening, and we'll see you next time.